look at when we're pre-qualifying someone. And I broke it down to 3 major steps. Your DTI, which is your debt to income. The second one is your credit and funds. The last one. So we're going to talk about each and every one of them, and I'll break it down to you guys as much as I can. Your DTI, your debt to income. That's, in the state of California right now, the maximum that anybody can borrow is about 49.9% of their income. To explain that to you. What is debt? What are we talking about debt? We're not talking about your electricity bill. We're not talking about your gas bills. We're going to talk about loans, anything you borrowed, anything federally by a judge that you have to pay. Those what count as debt. And we're looking at your monthly debt. What I mean by that is, what is your monthly payment on your car? Let's say you have a $300 car payment. You have $200 worth of credit cards. You have alimony with child support of $150 a month. This is what constitutes as your debt. Not your electricity bill, not what you're paying to your neighbors, unless it's a personal loan that actually you have papers on it. So anything that you borrowed and you have to make payments on, we're looking for your monthly payments, and that would constitute as your debt. Now, in this case, you got $650 worth of debt every month. We're going to calculate your income. Debt to income. Now, you guys are 1099, most of you guys. Most of the people I'm working with right now are, you guys can make up to $200,000. But that's not what you're telling Uncle Sam, is it? After deductions, after what you take, you'll probably be reporting 80,000, 90,000, hopefully more. So that's what we are looking for. We're not looking what you really made, we're looking what you're telling Uncle Sam that you made, what you're paying taxes on that you made. And we're looking for the gross amount before the taxes is being taken out. So let's say you filed $50,000 worth of income. I'm sorry, let's make it even. $60,000 worth of income a year. Divide that by 12. That's
5,000.
Sorry. Gracias. $5,000. $5,000 a month is what you're making. If your debt is $650, who got a calculator? $650. Wow. Hey?
No mortgage payment?
Pardon me?
They don't have mortgage payment?
Any loans, if you have a mortgage payment. We're talking about a first-time home buyer, that they don't have any mortgage payments. But if they do have rental properties, have any mortgage payments, that has to be calculated in their debt. And when you calculate their income, that should tell you the percentage. So, rule of thumb, 50% of what you're bringing in monthly is what you can borrow out. So now if I'm going to borrow $200,000, an average loan on $200,000, we're looking at about $1,400 to $1,500 mortgage payment. $1,400 to $1,500 mortgage payment plus the $650. That's $2,150 is what I'm paying. Now, you remember how much I'm making a month? $5,000. Am I still under the 50% DTI?
Yeah.
So we qualify on your debt to income. The next thing you guys need to remember when it comes to debt to income, there's a lot of programs out there like the DAISY, like the NSP, which is the Neighborhood Stabilization Program, the CHDAB. There's several different programs out there, and those programs have some strict DTIs. What I mean by that, the city of Victorville right now, on the NSP program, 45% of your DTI max. I can't go higher than that. So despite if your credit is great, despite if whatever everything else qualifies, if your DTI is above 45%, forget about it. We cannot get into that program. So keep that in mind because your DTI is very important. We want to make people conscious of their income and what they want to spend because we want them to keep the house for a long time. And that's what we're trying to do. Yes, Ruby?
What if I have 7 credit cards with 0 balances?
Minimum payment.
Does that affect?
We calculate your minimum payment. I'll take your minimum payment on that.
So if it's zero.
There's zero.
Zero balance.
Pardon
Still
me?
have service fees.
If it's a 0 balance, because someone had told me that if the credit is available to you, then it's counted against you.
They calculate about 15.
We will calculate that against you, but it's not that major. It's not that big. I mean, we're going to take the minimum payment. Like Sam said, there are probably going to be some service fees that we have to look into and figure out how much that's going to be to calculate that into debt to income. But usually that's not the biggest issue. For me, the biggest issue usually is your car payments. That's a lot of the biggest debts out there right now. Credit cards is not as much. Now, student loans, if it's deferred or not, that actually gets calculated against your debt to income. But there's always ways that we can figure out to defer them or move them forward, sign up for new credits. There's several different ways that we can avoid calculating the student loans. Any questions about the DTIs? Does everybody understand what we're looking for when we calculate debt to income? So just another rule of thumb, when you got somebody that's want to buy a house, and the first thing you should ask them is like, how much would you like your monthly payment to be? Not how much you want to borrow. Because if they said, I want to stay around $1,000, that's what I'm comfortable with a month. That means how much, do you know how much that you're going to allow them to borrow?
150, 140.
120.
About 100, between 120 to 140, depends on the interest rate, depends on how much you're bringing down, depends on a lot of factors. But $1,000 payment, between 120 to 140. That's what I feel comfortable saying to the client. But obviously, keep in mind the interest rate will play a factor. That down payment will play a factor. There's several things that will play a factor in that. Yes, Margaret?
If I want to pay no more than 1,500 mortgage payment, so how do I calculate how much I can borrow?
You know, I cannot give you a straight answer for this because if property taxes varies. You know, the insurance varies. Are they paying PMI, private mortgage insurance? Are they not paying PMI? There's a lot of different factors that would actually defer me to tell you what the loan amount will be. But at $1,300 a month, doing FHA with 3.5% down, I comfortably can tell you you're looking at about $160,000 to $180,000 loan. That's from my personal experience, and that's FHA with 3.5% down. Down payment affects it, interest rate affects it, PMI affects it, so there's a lot of different factors. Does that help? Okay, credit score. What is the minimum credit score that most agencies right now accept?
640.
620.
590.
550. I can do 550 KK.
590.
Mortgage, 550.
I don't know.
580.
Yeah, I can do
590.
580. 580 is a really good number, and that's actually a really low score for us to be able to finance someone. We can do FHA of 580, but there's actually different programs that you qualify for 580. Going back to the programs that the city can offer, a lot of these city programs require a minimum of 640, 680 scores. Most of them out there. So keep that also in mind when you try to sell a program to your client. Say, hey, don't worry about it. We can get it from the city. Don't get their hopes up. Remember that the credit score, the DTI is going to be a factor, and the property has to be a factor as well in a lot of these
Some of
programs.
them are income-based too.
Correct.
They can be overqualified.
The NSP is income-based. It's actually, if you go to their website, there's some really nice steps that breaks it down and tells you what's qualifications, what not. And it gives you like a table. It tells you based on their income, how many household members, what they qualify, and so on. Take a look at that. It is very helpful information. The third thing, funds. How many of you made an offer and the selling agent said, you know what, I need a proof of funds?
No funds.
All of them.
What are we talking about, proof of funds? What are we looking for?
Funds to close.
Cash on hand.
Yes. Where are they coming with the down payment? Are they paying the closing cost? We want to know where the money coming from. Now, unfortunately, the federal government right now makes us write an LOE, which is a letter of explanation, for any amount larger than $500 cash deposit into your account. So every time I see a deposit cash larger than $500, I need an explanation. A written explanation with your signature on it. Where's that money coming from? We have to go back and figure out where's the money coming from. Is if it's a gift, you're going to write a gifted letter signed by you and the person that gifted you that letter. So keep that in mind when you talk to your clients. Ask them these questions. You're looking to buy a house. How much you want to put down? And where's that money coming from? Is it your bank account? Is it your father's? Is it your uncle's? Are you borrowing it from someone? Is it 401k? Whatever the situation, get those answers because that's going to help you. First of all, it's going to show that you're knowledgeable in what you're trying to sell. Second of all, it's going to save you some time. I want you to send them to me. Don't get me wrong. Please send them to me all day long, and I'll be more than happy to help you. And for the ones that worked with me, I am old-fashioned. I don't do computer. I don't pull your credit on the spot. I'm going to sit with the client face-to-face. I do a 1003 by hand because I want to understand the story. I want to see the customer. I want him to tell me where's his money's coming from. I want him to tell me how much they want to borrow and what they're comfortable with. Not on an application. I want him to tell me that. And then from there, we can build it up, and then we can finish out the application. Any questions about the pre-qual process? Do you guys think
Yes,
that?
as agents, how many people have access to run somebody's credit?
Access to what?
Run somebody's credit? Very few. in general, when I've sat with clients, I've got a lot of that lending experience too. I've never sat with somebody when they told, oh, my credit's trash, I ain't never paid nobody on time in my life. They don't tell you that. Everybody's got good credit. People also don't realize that when they co-sign for their kid's car, that sometimes it shows on their credit. All this stuff is great, but realistically, call John. You know, we don't have the tools as agents to do accurate qualification process. We don't have their taxes in front of us, we don't have their credit report. We should get their bank statements, because most every offer does require proof of funds now. But call the professionals. You know, every time I've had an agent try to qualify them themselves, it ends up to be, you know, we don't know what we're doing in general. We don't have access to the tools. So this is great, but I'd rather for John to talk about the new short sale change rules. Hate to change his agenda, but the timeline is changing on what people can buy new properties after short sales. And I think that's, you know, we can use that more. You guys shouldn't be qualified. You know, clients aren't gonna give you their tax returns. You know, they might gross $100,000. I made $100,000 last year. If they're on a Schedule C and self-employed, they wrote it all off, they might have made 20. You know, you need to see the documentation. You know, you can't base your qualification on what people tell you.
And
You know,
to confirm
hate to
what he's
bust your
saying,
bubble a little bit, but you know, I'm the devil's advocate when it comes to this lending thing, you know.
I do, you know, I'm sorry to say so, but people do lie, unfortunately. So, you know, that's a fact. To your surprise, I hope you're not got surprised about this. So, when we give you, from my office, personally, a pre-approval, not a pre-qualification letter, a pre-approval letter, I have done their VOE, a verification of employment. I called the employer, HR department, figured out what they're getting paid. I did my research before I give you that. And the reason we do that, because how many of you lost a deal on escrow 3 weeks into it? Several of you. Because the loan officers did not really pull credit from 3 agencies. They're trying to be cheap. Or the loan officers didn't really call their VOE and verify their employment. So when we give you a pre-approval, we're guaranteeing you that this deal is gonna close. When I tell you this is what it's gonna be, this is exactly what's gonna be by the end of the escrow. Sounds good?
Good.
Any questions, complaints, or concerns? Take them to Sam.
Tell us about the short sale change.